Welcome to Real Estate Advantage, your #1 source to help you pass your real estate exam. Today, we have prepared 300 real estate vocabulary terms that you should be familiar with for your exam. To make the terms easier to learn, we've broken down the terms into 6 sets of 50 in flashcards format. Now, here is your instructor with a live reading of the 300 vocabulary terms.
80-10-10. 80-10-10 is a financing arrangement commonly used in real estate. It involves putting down a 10% down payment and taking out 2 loans to cover the remaining 90% of the purchase price. The first loan is usually for 80% of the purchase price, and the second loan is for the remaining 10%, allowing buyers to avoid paying private mortgage insurance and qualify for a larger loan amount. Abstract of title. An abstract of title is a written history of all legal documents and public records that pertain to a piece of real estate, including deeds, mortgages, liens, judgments, and encumbrances. This document provides a summary of the property's ownership history and helps to establish clear title to the property. It is commonly used in real estate transactions to ensure that there are no outstanding claims or issues that could affect the property's value or ownership. Abutting. Abutting refers to a property or land that shares a boundary or touches another property or land. In real estate, the term is often used to describe the physical relationship between adjacent properties or parcels of land. Acceleration clause. An acceleration clause is a provision in a mortgage or loan agreement that allows the lender to demand immediate repayment of the entire outstanding balance if the borrower fails to meet certain conditions, such as making timely payments or maintaining insurance coverage. This clause is designed to protect the lender's interest and can be triggered by a default or breach of the loan agreement. Acceptance. In real estate, acceptance refers to the agreement of one party to the terms and conditions of an offer made by another party. It is a crucial step in the process of forming a legally binding contract for the sale or lease of real property. Once the offer is accepted, the parties are bound by the terms of the contract, subject to any contingencies or conditions that may be included. Accretion. Accretion refers to the gradual increase in the size or extent of land by the deposition of soil or other natural materials, such as sand or rock, through the action of water, wind, or other natural forces. This process can result in the formation of new land or the expansion of existing land and can have important legal implications for property ownership and boundaries. Acknowledgement. In real estate, an acknowledgement is a formal declaration by a person that they have signed a legal document, such as a deed or mortgage, voluntarily and for the purposes stated in a document. The acknowledgement typically involves the signer affirming their identity and acknowledging that they understand and agree to the contents of the document. The purpose of an acknowledgement is to provide evidence that the signature on the document is genuine and was not obtained by fraud or coercion. Acre. An acre is a unit of measurement used to describe the size of a parcel of land in real estate. 1 acre is equal to 43,560 square feet, or approximately 90% of the area of an American football field, excluding the end zones. The acre is commonly used to measure the size of agricultural and rural properties, as well as large urban parks and estates. Ad valorem. In real estate, it refers to a type of property tax that is based on the assessed value of the property. Ad valorem taxes are typically calculated as a percentage of the assessed value and are used to fund local government services such as schools, roads, and public safety. Additional principal payment. An additional principal payment is an extra payment made by a borrower on top of their regular mortgage payment towards the principal balance of a loan. By making additional principal payments, borrowers can reduce the amount of interest paid over the life of the loan and shorten the loan term. This can result in significant savings in interest payments and help borrowers build equity in their property faster. Adjustable rate mortgage, ARM. An adjustable rate mortgage, ARM, is a type of mortgage in which the interest rate fluctuates based on a specified index, such as the prime rate or LIBOR. The interest rate on an ARM is typically lower than a fixed-rate mortgage initially, but can increase or decrease over time, causing the borrower's monthly payments to rise or fall accordingly. ARM loans usually come with caps on how much the interest rate can increase or decrease during a given period, and they can be a good option for borrowers who plan to sell or refinance their property in the near future. Adjusted basis. Adjusted basis refers to the original cost of a property plus the value of any improvements or additions made to the property minus any deductions taken for depreciation or other factors. The adjusted basis is used to calculate the amount of gain or loss when a property is sold, and it can have important tax implications for property owners. Adjustment date. An adjustment date in real estate refers to the date on which certain financial adjustments are made between the buyer and seller of a property. These adjustments may include prorated expenses such as property taxes, homeowners association fees, and utility bills. The adjustment date is typically set at the time of closing and is used to ensure that both parties are responsible for their fair share of the expenses related to the property during their respective ownership periods. Adjustment period. An adjustment period in real estate refers to the interval of time between interest rate adjustments on an adjustable rate mortgage, ARM. This is the period during which the interest rate on the mortgage is fixed and does not change. The length of the adjustment period is typically 1, 3, 5, or 7 years, after which the interest rate can adjust based on the specified index. Adjustments. Adjustments in real estate refer to the process of making financial adjustments between the buyer and seller of a property to ensure that both parties pay their fair share of the expenses related to the property. These adjustments may include prorated expenses such as property taxes, homeowners association fees, and utility bills. Adjustments are typically made at the time of closing and can have significant financial implications for both parties. Administrator/administratrix. An administrator or administratrix in real estate refers to a person appointed by a court to manage the estate of a deceased individual who did not leave a will or did not name an executor in their will. The administrator is responsible for distributing the deceased person's assets according to state law and may be required to sell any real estate holdings to satisfy debts or distribute assets to heirs. Adverse possession. Adverse possession in real estate refers to a legal doctrine that allows a person to acquire ownership of someone else's property by occupying it continuously for a specified period of time without the owner's permission. The occupier must meet certain requirements, such as openly occupying the property, paying property taxes, and treating the property as their own. Adverse possession can be a complex and controversial legal issue, and the rules governing it vary by state. Affidavit. An affidavit in real estate is a written statement made under oath or affirmation, typically used to confirm or verify facts or information related to a real estate transaction. Affidavits may be used in a variety of situations, such as when a person is unable to produce a required document or when there is a dispute over the ownership or condition of a property. Affidavits are legally binding and can have important consequences for the parties involved. Agency. Agency in real estate refers to the relationship between a real estate agent and their client, whether the client is a buyer or seller. The agent has a fiduciary duty to act in the best interest of their client and to provide them with professional advice and guidance throughout the real estate transaction. The agency relationship can be established through a written agreement, such as a listing agreement or a buyer's representation agreement. Agent. In real estate, an agent is a licensed professional who acts on behalf of another person, whether as a buyer's agent, a seller's agent, or a dual agent representing both parties in a transaction. The agent has a fiduciary duty to act in their client's best interest, provide professional advice and guidance, and help negotiate the terms of the real estate transaction. Agents may work for a brokerage or as independent contractors. Alienation clause. An alienation clause in real estate is a provision in a mortgage or other loan agreement that prohibits the borrower from transferring ownership of the property without the lender's consent. The clause is designed to protect the lender's security interest in the property and ensure that they have the opportunity to approve any potential new owner's creditworthiness before allowing a transfer of ownership. Amenities. Amenities in real estate refer to features or facilities that enhance the appeal, comfort, or convenience of a property. These may include things like swimming pools, fitness centers, concierge services, parking, and in-unit laundry. Amenities can be a significant factor in determining the value and desirability of a property, particularly in multifamily or commercial real estate. Amendment. An amendment in real estate refers to a change or modification made to a legal document, such as a purchase agreement, lease, or contract. The amendment typically outlines the specific changes being made and must be signed by all parties involved in the original agreement. Amendments can be used to update or revise terms, extend deadlines, or clarify details of a real estate transaction. Amortization. Amortization in real estate refers to the process of gradually paying off a loan over a period of time, typically through a series of regular payments that include both principal and interest. The amortization schedule outlines the specific amounts of each payment that go towards interest and principal and how much of the loan balance remains after each payment. Amortization is a common feature of many types of loans used in real estate, such as mortgages and commercial loans. Amortized mortgage. An amortized mortgage in real estate is a type of loan where the borrower makes regular payments that include both principal and interest, gradually paying off the loan over time. The payment schedule is structured so that each payment goes towards reducing the loan balance while also covering the accrued interest. This type of mortgage is common in residential real estate, particularly for home buyers who plan to stay in their home for a longer period of time. Annual membership. Annual membership in real estate typically refers to a fee paid by property owners to access shared facilities, amenities, or services within a community or development. The membership may be mandatory or optional and can cover things like maintenance of common areas, security, or use of recreational facilities like pools or fitness centers. Annual membership fees are often set by the homeowners association or other governing body of the community. Antitrust laws. Antitrust laws in real estate are a set of regulations designed to promote fair competition in the marketplace and prevent monopolies or other anti-competitive practices. These laws prohibit activities like price fixing, bid rigging, and market allocation that could lead to reduced competition and higher prices for consumers. Real estate professionals must be aware of antitrust laws and ensure that their business practices are in compliance with these regulations. Application. In real estate, an application typically refers to the process of submitting a formal request to rent a property or apply for a mortgage. The application may include personal and financial information, such as credit history, income, and employment verification, as well as details about the property or loan being sought. The property owner or lender will use the information provided in the application to determine whether to approve or deny the request. Application fee. An application fee in real estate is a one-time charge paid by a prospective tenant or borrower to cover the costs associated with processing their application. The fee is typically non-refundable, even if the application is denied, and may be used to cover expenses like background checks, credit reports, or administrative costs. The amount of the application fee can vary depending on the property owner or lender and the type of application being submitted. Appraisal. An appraisal in real estate is an estimation of the value of a property, typically performed by a licensed appraiser. The appraisal takes into account factors such as the property's location, condition, and features, as well as recent sales of comparable properties in the area. Appraisals are used by lenders to determine the value of a property for a mortgage and by buyers and sellers to determine a fair price for a property. Appraised value. The appraised value of a property in real estate is an estimate of its fair market value based on an appraisal performed by a licensed appraiser. The appraised value takes into account factors such as the property's location, size, condition, and comparable sales in the area. The appraised value is used by lenders to determine how much they are willing to lend for a mortgage and by buyers and sellers to determine a fair price for the property. Appreciation. Appreciation in real estate refers to an increase in the value of a property over time due to factors such as market conditions, renovations, or improvements to the property. Appreciation is often seen as a positive aspect of owning real estate, as it can lead to a higher resale value or increased equity. However, appreciation is not guaranteed, and there is always the possibility that the value of a property could decrease over time. Asking list price. The asking price, also known as the list price, is the price at which a property is advertised for sale by the seller or listing agent. This price is typically set based on market conditions, the property's location, size and condition, and comparable sales in the area. The asking price is not necessarily the final price the property will sell for, as buyers may negotiate a lower price based on their own analysis and market conditions. Assessor. An assessor is a public official who is responsible for determining the value of real property for tax purposes. This involves conducting assessments of properties within a particular jurisdiction to determine their current market value, which is then used to calculate property taxes. Assessors typically use a variety of methods, including sales data, comparable property values, and physical inspections to determine a property's value. Assignee. An assignee is a person or entity to whom an interest in a property or a contractual right is transferred by another party known as the assignor. In the context of real estate, an assignee can be someone who acquires the rights to a lease or a purchase agreement from the original tenant or buyer, respectively. The assignee takes on the rights and obligations of the original party and becomes responsible for fulfilling the terms of the agreement. Assignment. Assignment in real estate refers to the transfer of ownership or rights of a property or a contract from one party, the assigner, to another party, the assignee. In the context of real estate, an assignment can occur when a buyer of a property transfers their purchase agreement to another party, or when a tenant transfers their lease agreement to a new tenant. The assignee takes on the rights and obligations of the original party and becomes responsible for fulfilling the terms of the agreement. Assumable mortgage. An assumable mortgage is a type of home loan that allows a buyer to take over the seller's existing mortgage rather than applying for a new loan. This can be beneficial for the buyer, as they can often take advantage of the seller's lower interest rate, potentially saving them money in the long term. However, assumable mortgages are not common and typically require the lender's approval. Assumable mortgage. An assumable mortgage is a type of home loan that allows a buyer to take over the seller's existing mortgage rather than applying for a new loan. This can be beneficial for the buyer, as they can often take advantage of the seller's lower interest rate, potentially saving them money in the long term. However, assumable mortgages are not common and typically require the lender's approval. Assumption of mortgage. Assumption of mortgage is the process of taking over an existing mortgage from the current owner of a property and agreeing to repay the outstanding debt. This can be beneficial for the new owner, as they may be able to assume the previous owner's interest rate and terms, potentially resulting in lower monthly payments. However, assumption of mortgage is not always possible and usually requires lender approval. Attachment. In real estate, an attachment refers to the legal seizure of a property to satisfy a debt or judgment owed by the property owner. This means that the property can be taken by the creditor to pay off the debt if the owner does not fulfill their obligations. An attachment is usually initiated by court order and can be enforced by a sheriff or other law enforcement officials. Attorney's opinion of title. An attorney's opinion of title is a legal document that outlines an attorney's professional judgment on the status of a property's ownership. This opinion confirms that the title to the property is clear and free of any legal claims, disputes, or issues, and is necessary for property buyers to obtain title insurance. Attractive nuisance. An attractive nuisance is a dangerous condition or object that is likely to attract children, such as a swimming pool, abandoned building, or construction site. Property owners may be held liable for injuries or damages resulting from an attractive nuisance on their property, even if the child was trespassing at the time. Auction. An auction is a public sale in which properties or goods are sold to the highest bidder. Real estate auctions may be conducted live or online and may be used to sell foreclosed properties, commercial real estate, or other types of properties. The sale is typically final and may require bidders to have pre-approval for financing or to provide a deposit at the time of bidding. Balloon mortgage. A balloon mortgage is a type of mortgage that requires the borrower to make small payments over a set period, usually 5 to 7 years, followed by a large balloon payment at the end of the loan term. The balloon payment is typically equal to the remaining balance of the loan and must be paid in full by the borrower. Balloon payment. A balloon payment is a large lump sum payment that is typically due at the end of a loan term, often associated with balloon mortgages. Balloon payments are typically larger than regular payments made throughout the loan term and are used to reduce the overall cost of borrowing in the short term. Bill of sale. A bill of sale is a document that serves as proof of the transfer of ownership of personal property from one party to another. It includes details about the buyer and seller, the item being sold, and the date and location of the sale. A bill of sale may be required for legal or tax purposes and is typically signed by both parties. Blanket mortgage. A blanket mortgage is a type of loan that is secured by multiple properties or parcels of land. This means that the borrower is able to use several properties as collateral for the loan instead of just one. Blanket mortgages are often used by real estate investors to finance multiple properties at once and can be a useful tool for consolidating debt or expanding a real estate portfolio. Blockbusting. Blockbusting is the illegal practice of inducing homeowners to sell their property. Blockbusting is the illegal practice of inducing homeowners to sell their property by suggesting that members of a protected class, e.g., race, religion, national origin, etc., are moving into the area and will lower property values. This practice is prohibited by the Fair Housing Act. Bond. In real estate, a bond refers to a written obligation that guarantees a certain performance or payment. Bonds can be used in various situations, such as when a contractor is required to post a bond to ensure they complete a project, or when a tenant posts a bond to guarantee they will fulfill the terms of a lease. Bonds are typically issued by an insurance company or a surety. Bonus to selling agent, BTSA. A bonus to selling agent, BTSA, is a financial incentive offered by the listing agent to the selling agent to encourage them to sell a property. The bonus is typically a percentage of the sale price and is paid in addition to the commission the selling agent would normally receive. Breach of contract. Breach of contract refers to a situation where one party fails to perform their obligations as outlined in a contract. This can occur due to a variety of reasons, such as failing to make payments, failing to deliver goods or services, or violating the terms of the contract in some other way.
Congrats! You completed the first 50 terms. If you are getting value from this video, please like and subscribe for the latest updated videos. Now let's move on to the next 50 terms.
Brokerage. Brokerage refers to the business of acting as an intermediary between buyers and sellers in a real estate transaction. A brokerage firm typically employs licensed real estate agents who work to connect buyers and sellers, facilitate negotiations, and close deals. BTSA. BTSA stands for Bonus to Selling Agent. It refers to a commission or bonus paid by the listing agent or seller to the selling agent for bringing a successful buyer to a transaction. Building line. In real estate, a building line is a line established by a local government or other entity that designates the minimum distance that a building or other structure must be set back from the street or property line. Building lines are intended to ensure that there is adequate space between buildings and that the streetscape and overall character of a neighborhood are preserved. Bundle of rights. The bundle of rights is the concept that property ownership includes a set of legal rights that can be bought, sold, and transferred. These rights include the right to use, control, transfer, and exclude others from the property. Buy down. Buy down refers to a mortgage financing technique where the buyer pays an upfront fee to lower the interest rate on the mortgage. This fee is typically paid by the seller or builder of the property to make the mortgage more affordable for the buyer. Buyer's broker. A buyer's broker, also known as a buyer's agent, is a licensed real estate agent who represents the buyer in a real estate transaction. The buyer's broker is responsible for advocating for the buyer's interest, negotiating offers, and guiding the buyer through the home buying process. Calendar year. Calendar year refers to the period of time starting from January 1st and ending on December 31st of the same year. It is commonly used to measure financial and tax years, as well as for tracking various business and personal activities. Cap. In real estate, a cap refers to the maximum amount of interest rate that can be charged on an adjustable rate mortgage during each adjustment period, or the maximum amount by which the interest rate on a bond or other loan can increase. Caps are put in place to protect borrowers from large fluctuations in interest rates and to provide stability to the market. There are typically 3 types of caps: initial, periodic, and lifetime. Capital gains. Capital gains in real estate refer to the profit earned from the sale of a property or investment. The gain is calculated by subtracting the purchase price from the selling price and is subject to capital gains tax. Capitalization. Capitalization is the process of estimating the present value of an asset or investment based on its expected future income. In real estate, capitalization refers to the process of determining the value of a property based on its net operating income and the expected rate of return on investment. Capitalization rate. The capitalization rate, or cap rate, is a measure used in real estate to estimate the potential return on an investment property. It is the ratio of the net operating income of the property to its current market value or purchase price, expressed as a percentage. The higher the cap rate, the higher the potential return on investment, but also the higher the risk. Cash out. In real estate, cash out refers to the process of refinancing a property for an amount greater than the current mortgage, resulting in cash proceeds to the borrower. This can be a useful strategy for homeowners who want to use the equity in their home for other purposes, such as home improvements or debt consolidation. CC&R. CC&R stands for Covenants, Conditions, and Restrictions, which are legally binding rules and regulations that govern a specific property or community. These rules can cover a wide range of topics, such as architectural standards, noise restrictions, and landscaping requirements, and are designed to maintain property values and ensure the peaceful enjoyment of the community by its residents. CCCS. In real estate, CCCS stands for the Consumer Credit Counseling Service. This is a nonprofit organization that offers assistance to individuals who are in financial difficulty, often providing advice and support for debt management and credit counseling. Real estate agents may recommend CCCS to clients who are struggling financially and need help managing their debt. Ceiling. In real estate, the term ceiling refers to the highest price that a property can sell for in the current market. It is often used in conjunction with the term floor, which represents the lowest price that a property can sell for in the current market. Together, the ceiling and floor help to define the range of possible prices for a property. Census. In real estate, a census is the official count of the population and households within a particular area, such as a city, county, or state. This information is important for real estate professionals to understand market demographics, including the number of potential buyers or renters in a given area. Additionally, census data can also help inform decisions about zoning and development regulations, transportation planning, and other aspects of community planning. Certificate of Eligibility. A certificate of eligibility is a document issued by the Department of Veterans Affairs that verifies a veteran's eligibility for a VA home loan. This certificate includes information such as the veteran's service history, discharge status, and entitlement amount. It is a crucial document that enables veterans to obtain favorable financing terms and purchase a home with little or no down payment. Chain of title. Chain of title refers to the chronological order of documents and records that trace the ownership of a property over time. It includes deeds, mortgages, liens, and other legal documents that affect the title to the property. A clear chain of title is necessary to establish legal ownership and transfer of the property. Channeling. Channeling in real estate refers to the practice of directing home buyers toward or away from certain neighborhoods based on their race, national origin, or other protected characteristics. It is a form of housing discrimination that is illegal under federal and state fair housing laws. Channeling can occur through various means, such as steering by real estate agents or advertising that implies a preference for certain types of buyers. Chattel. Chattel in real estate refers to personal property that is movable and not affixed to the land or a building. Examples of chattels include furniture, appliances, and vehicles. Chattels are typically not included in the sale of a property unless otherwise specified in the purchase agreement. Cleaning fee. A cleaning fee in real estate refers to a fee charged by a landlord or property manager to cover the cost of cleaning a rental unit after a tenant moves out. This fee is typically deducted from the tenant's security deposit and is used to cover the cost of cleaning the unit to prepare it for the next tenant. The amount of the cleaning fee varies depending on the size and condition of the unit. Clear title. Clear title in real estate refers to ownership of a property that is free of any liens, encumbrances, or legal disputes that could affect its transferability. A clear title means that the seller has the legal right to sell the property and transfer ownership to the buyer without any legal complications or third-party claims. Obtaining a clear title is a critical step in any real estate transaction. Closing. Closing in real estate refers to the final stage of a property sale where the transfer of ownership from the seller to the buyer takes place. It typically involves the exchange of funds, signing of legal documents, and recording of the transaction in public records. Closing is also known as settlement or completion and marks the end of the buying or selling process. Closing costs. Closing costs in real estate refer to the fees and expenses associated with the purchase or sale of a property that are paid at the closing. These costs can include fees for title search, appraisal, survey, attorney, mortgage application, and property insurance, among others. Closing costs are typically paid by both the buyer and the seller, and the amount varies depending on the location and the value of the property. Closing statement. A closing statement in real estate is a document that outlines the final financial details of a property sale, including the total amount of money owed by the buyer and the amount received by the seller. It lists all the credits and debits associated with the sale, such as closing costs, prorated property taxes, and mortgage payments. The closing statement is typically prepared by a closing agent or attorney and is reviewed and signed by both the buyer and the seller at the closing. Cloud on title. A cloud on title in real estate refers to any claim or encumbrance that casts doubt on the ownership of a property or affects its transferability. It can include liens, easements, outstanding mortgages, or unresolved legal disputes. A cloud on title can make it difficult to sell or refinance a property until the issue is resolved or cleared. Co-op. A co-op, short for cooperative housing, is a type of residential real estate where residents own shares in a corporation that owns the building rather than owning the physical unit itself. Co-op residents typically pay monthly maintenance fees that cover the building's expenses, including property taxes, maintenance, and utilities. Co-op boards, composed of elected residents, oversee the management of the building and the admission of new residents. Co-tenants. Co-tenants in real estate refer to multiple individuals who share the ownership of a property with equal or unequal interest. They may own the property as tenants in common, joint tenants with rights of survivorship, or tenants by the entirety, depending on the jurisdiction and the nature of the ownership. Co-tenants share the responsibility for maintaining the property, paying property taxes and insurance, and making decisions about the property's use and disposition. Collateral. Collateral in real estate refers to a property or asset that is pledged as security for a loan. It can include real property, such as a house or a piece of land, or personal property, such as a car or a valuable object. If the borrower defaults on the loan, the lender can seize the collateral and sell it to recover the outstanding debt. Commingling. Commingling in real estate refers to the mixing of personal funds with client funds or escrow funds. It is illegal and unethical for real estate agents or brokers to commingle funds because it can lead to fraud or misappropriation of funds. Real estate professionals are required to keep client funds separate from their personal funds and maintain accurate records of all transactions to ensure transparency and accountability. Commission. Commission in real estate refers to the fee paid to a real estate agent or broker for their services in facilitating the sale or purchase of a property. It is typically a percentage of sale price agreed upon by the seller and the agent or broker before the property is listed. The commission covers the cost of marketing the property, arranging showings, negotiating offers, and closing the sale. Community Reinvestment Act. The Community Reinvestment Act, CRA, is a U.S. federal law that was enacted in 1977 to encourage banks and other financial institutions to invest in low-income and underserved communities. The law requires banks to provide credit and other financial services to these communities, including affordable housing loans and small business loans, and to demonstrate their commitment to community reinvestment through regular reporting and assessment. The CRA aims to promote economic development and access to credit in historically disadvantaged areas. Comparables. Comparables, also known as comps in real estate, refer to recently sold properties that are similar in size, location, and features to a property being appraised or listed for sale. Real estate agents, appraisers, and buyers use comparables to determine the market value of a property and set a fair price. Comparables can include properties that have sold within the past 6 months or less and are located within a reasonable distance from the subject property. Compound interest. Compound interest in real estate refers to the interest earned on the principal amount of a loan, as well as on the accumulated interest over time. It can result in significant growth in the amount owed or earned on a loan or investment, particularly over long periods. Compound interest can be calculated at various intervals, such as monthly, quarterly, or annually, depending on the terms of the loan or investment. Condemnation. Condemnation in real estate refers to the process by which a government agency or other authorized entity takes private property for public use, typically through eminent domain. The property owner is usually compensated for the value of the property, but may also have legal recourse to challenge the taking or negotiate for higher compensation. Condemnation can occur for various public purposes, such as the construction of highways, public utilities, or parks. Condominium. A condominium, commonly known as a condo, is a type of residential property in which individuals own a unit within a larger building or community, as well as a share of the common areas and facilities such as swimming pools, gyms, and parking lots. Condo owners are responsible for maintaining their individual units and paying monthly fees to cover the shared expenses and upkeep of the common areas. Condominiums offer a more affordable and convenient alternative to single-family homes for many home buyers. Consideration. Consideration in real estate refers to something of value, such as money, goods, or services, that is given by one party in exchange for something of value given by another party in a contract or transaction. In a real estate sale or lease, consideration typically refers to the price or rent paid for the property. Consideration is a necessary element of a valid contract and must be sufficient to make the agreement legally enforceable. Constructive eviction. Constructive eviction in real estate occurs when a tenant is forced to move out of a rental property because the landlord has breached the lease agreement, such as by failing to maintain the property in a habitable condition or by violating the tenant's right to quiet enjoyment. The tenant may claim constructive eviction as a defense against eviction or to seek damages from the landlord. Constructive eviction is different from actual eviction, which involves the landlord physically removing the tenant from the property through legal means. Consumer Credit Counseling Service, CCCS. Consumer Credit Counseling Service, CCCS, is a nonprofit organization that offers financial education and debt management services to consumers, including those who are struggling with mortgage payments. CCCS provides counseling and budgeting assistance to help individuals better manage their finances and avoid foreclosure. They can also negotiate with creditors to obtain lower interest rates, waive fees, or develop payment plans on behalf of their clients. Contingency. A contingency in real estate refers to a condition or requirement that must be met in order for a contract or transaction to proceed. Common contingencies in real estate contracts include the buyer's ability to obtain financing, the outcome of a home inspection, or the sale of the buyer's existing property. If a contingency is not met, the contract may be terminated or renegotiated. Contract. A contract in real estate is a legally binding agreement between two or more parties, such as a buyer and a seller or a landlord and a tenant. A contract outlines the terms and conditions of the transaction, including the price, the property description, and the rights and obligations of each party. To be valid, a contract must be voluntary, mutual, and supported by consideration. Contract for deed. A contract for deed is a legal agreement between a buyer and a seller of real estate in which the seller finances the purchase of the property instead of a traditional lender. The buyer makes payments directly to the seller over a period of time, typically several years, until the purchase price is paid in full and the title of the property is transferred to the buyer. Contract for deed agreements may be used as an alternative to traditional mortgage financing, especially when the buyer cannot obtain a mortgage due to poor credit or lack of a down payment. Contract for exchange of real estate. A contract for exchange of real estate, also known as a swap or a trade, is a legal agreement between two parties to exchange real property instead of buying and selling it for cash. The agreement outlines the terms and conditions of the exchange, including the properties being exchanged, their values, and any other considerations. Contract for exchange of real estate may be used to achieve specific goals, such as tax benefits, diversification of real estate portfolios, or consolidation of ownership. Contract of sale. A contract of sale, also known as a purchase agreement or sales contract, is a legally binding agreement between a buyer and a seller of real estate that outlines the terms and conditions of the transaction. The contract of sale includes information such as the purchase price, the closing date, the property description, and any contingencies or conditions that must be met for the sale to proceed. Once both parties have signed the contract of sale, it becomes legally binding, and both parties are obligated to fulfill their obligations under the terms of the agreement. Conventional loan. A conventional loan is a type of mortgage loan that is not insured or guaranteed by a government agency, such as the Federal Housing Administration, FHA, or the Department of Veterans Affairs, VA. Instead, conventional loans are backed by private lenders and investors and typically require a higher down payment and stricter credit qualifications than government-backed loans. Conventional loans may be either conforming or non-conforming, depending on whether they meet the guidelines established by Fannie Mae and Freddie Mac. Conveyance. Conveyance refers to the transfer of ownership or title of real property from one party to another. This can occur through a sale, gift, inheritance, or other legal means. The term conveyance may also refer to the legal document, such as a deed or bill of sale, that is used to transfer ownership or title. Cooperative housing. Cooperative housing, or co-op for short, is a type of residential community where residents own shares in a corporation that owns the entire property rather than owning individual units outright. Each shareholder has the right to occupy a specific unit, and the corporation is responsible for managing and maintaining the property. Co-op residents typically pay monthly maintenance fees that cover their share of the corporation's expenses, such as mortgage payments, property taxes, and maintenance costs. Cooperative sale. A cooperative sale refers to the sale of shares in a cooperative housing corporation rather than the sale of a physical unit or property. When a buyer purchases a cooperative share, they become a shareholder in the corporation that owns the property, and they are granted the right to occupy a specific unit within the building. The sale is typically subject to the approval of the corporation's board of directors, and the buyer may be required to meet certain eligibility criteria. Cost approach to value. The cost approach to value is a method used in real estate appraisal to estimate the value of a property by considering the cost of reproducing or replacing the property. The approach takes into account the cost of land, labor, materials, and other factors that would be required to rebuild the property from scratch, and then adjust the value based on the property's age, condition, and other relevant factors. Counteroffer. A counteroffer in real estate occurs when a seller responds to a buyer's offer with modified terms that are different from the original offer. This modified offer constitutes a new offer, which the buyer may choose to accept, reject, or make a counteroffer in return. Counteroffers can continue until both parties reach an agreement or either party chooses to end negotiations. Covenant. In real estate, a covenant is a legally binding promise between two parties, typically the seller and the buyer, that is included in a deed or other legal document. Covenants can impose certain restrictions or obligations on the property, such as limitations on its use, maintenance requirements, or provisions for payment of fees or assessments. Covenants can also be used to protect the value or character of a neighborhood or community, such as by requiring adherence to certain architectural or landscaping standards. Covenants, conditions, and restrictions, CC&Rs. Covenants, conditions, and restrictions, CC&Rs, are rules and regulations that are typically attached to a property deed by a developer or a homeowners association, HOA, to maintain a certain standard of living within a community. These restrictions may include requirements for maintenance, limitations on property use, and guidelines for architectural design, among others. Credit Bureau. A credit bureau is an agency that collects and maintains records of individuals' credit histories and provides credit reports to lenders, landlords, and other authorized parties. The reports include information about an individual's credit accounts, payment history, and credit score, which is used to assess creditworthiness and determine eligibility for loans, credit cards, and other forms of credit. Credit file. A credit file is a detailed record of a person's credit history and current credit situation. It includes information such as credit accounts, payment history, outstanding debts, and any other relevant financial information used to determine creditworthiness. Credit files are used by lenders and financial institutions to evaluate loan applications and determine interest rates and credit limits. Credit insurance. Credit insurance is a type of insurance policy that is designed to pay off the borrower's outstanding debt in the event of a certain predetermined occurrence, such as death, disability, or job loss. This insurance is often used to protect against default on loans or credit lines and can be offered by the lender or purchased independently by the borrower. Credit limit. A credit limit refers to the maximum amount of credit that a lender is willing to extend to a borrower. It represents the upper bound of how much money the borrower can borrow and is usually based on the borrower's creditworthiness and income. Once the borrower reaches the credit limit, they may no longer be able to borrow until they have paid down some of their outstanding balance. Credit report. A credit report is a detailed summary of an individual's credit history that includes information about credit accounts, such as credit cards, loans, and mortgages, as well as payment history and outstanding balances. Credit reports are often used by lenders and other creditors to assess a borrower's creditworthiness and ability to pay back debt. Credit score. A credit score is a numerical representation of a borrower's creditworthiness. It is based on an analysis of the borrower's credit history, including factors such as payment history, outstanding debts, length of credit history, and types of credit used. A higher credit score generally indicates that a borrower is more likely to be approved for credit and may qualify for better interest rates and loan terms. Creditor. A creditor is an individual or organization that lends money or extends credit to another person or entity. The creditor expects repayment of the loan with interest and may also have the right to collect collateral or take legal action to recover funds in the event of default. Cul-de-sac. A cul-de-sac is a dead-end street with a circular turnaround area at the end, allowing vehicles to turn around easily without backing up. Cul-de-sacs are often used in residential areas to limit through traffic and provide a safer environment for pedestrians and children. DBA. DBA stands for Doing Business As, which is a legal term used to refer to a business that operates under a different name than its legal name. This is commonly used by sole proprietors and partnerships who wish to operate their business under a more memorable or catchy name. Debenture. In real estate, a debenture refers to a type of bond that is not secured by specific collateral. Instead, the issuer's creditworthiness and general reputation are the primary factors that investors consider when purchasing debentures. In some cases, debentures may be convertible into equity shares at a later date, providing additional flexibility for investors. Debt service. Debt service refers to the periodic payments made by a borrower to repay the principal and interest on a debt over a set period of time. In real estate, it typically refers to the amount of money required to service a mortgage loan, including both the principal and interest payments. Debt service ratio. The debt service ratio is a financial metric used to evaluate a borrower's ability to repay their debts. It measures the ratio of a borrower's monthly debt payments to their monthly income. A lower debt service ratio is generally considered more favorable, indicating that the borrower has more income available to meet their debt obligations. Deceptive Trade Practices Act. The Deceptive Trade Practices Act, DTPA, is a law that protects consumers from false or misleading advertising, marketing, or other business practices. It provides legal remedies to consumers who have been harmed by such practices, including the right to sue for damages and to seek injunctive relief. The DTPA applies to a wide range of industries, including real estate, and is enforced by the Attorney General's office in each state. Deduction. In real estate, a deduction refers to a reduction in the amount of taxable income. Deductions can be made for expenses related to owning or operating a property, such as mortgage interest, property taxes, and repairs. Deductions can help lower a property owner's tax bill and increase their net income. Deed. A deed is a legal document that transfers ownership of real property from one person or entity to another. It contains a description of the property being transferred and any relevant terms and conditions of the transfer. Deed in lieu of foreclosure. Deed in lieu of foreclosure is a legal process in which a borrower transfers the title of their property to the lender, typically a bank, in exchange for the forgiveness of the outstanding mortgage debt. This process is often used as an alternative to foreclosure and can help borrowers avoid the negative impact on their credit score that foreclosure can have. Deed of trust. A deed of trust is a legal document that is used in many states instead of a mortgage. It allows a borrower to transfer legal title to a trustee until a loan is paid off, while still allowing the borrower to possess and use the property as their own. If the borrower defaults on the loan, the trustee can initiate foreclosure proceedings on behalf of the lender. Deed restrictions. Deed restrictions, also known as restrictive covenants, are limitations imposed on the use of real property that are included in the deed to the property. These restrictions may include limitations on the type of structures that can be built, the materials that can be used, and the activities that can be conducted on the property. Default. In real estate, default refers to a borrower's failure to fulfill their obligations under the terms of a loan or mortgage agreement, such as making regular payments or meeting other contractual requirements. A default can lead to consequences such as late fees, legal action by the lender, or even foreclosure of the property. Defeasance. Defeasance is a clause in mortgage that allows the borrower to regain title to the property once the debt has been fully paid. Essentially, it extinguishes the mortgage and releases the property from the lender's lien. Defeasance can be used as an alternative to prepayment penalties when a borrower wants to pay off a mortgage early. Delivery. In real estate, delivery refers to the transfer of property ownership from one party to another. This can be done through physical delivery of the deed or through symbolic delivery, which can include the exchange of keys or other items that represent ownership. Delivery is a critical part of any real estate transaction and is necessary to finalize the transfer of ownership. Depreciation. In real estate, depreciation refers to the decrease in value of a property over time due to age, wear and tear, and other factors. It is a non-cash expense that can be used to reduce taxable income for property owners and investors. Depreciation is typically calculated using a formula that takes into account the property's cost, useful life, and salvage value. Descent. In real estate, descent refers to the transfer of property ownership from a deceased person to their legal heirs. This type of transfer occurs when the deceased person did not leave a will or if the will is invalid. The legal heirs are determined by state law and can include surviving spouses, children, parents, or siblings. Devise. In real estate, the term devise refers to the transfer of real property under a will or trust. It specifically refers to property that is passed down from a decedent to their heirs or beneficiaries. Disclosure. Disclosure in real estate refers to the act of revealing or making known certain information to interested parties about a property or a transaction. It is a legal requirement that certain information be disclosed, such as the presence of lead-based paint, known defects, or previous flood or fire damage. Discount points, or points. Discount points, also referred to as points, are fees paid to a lender at closing in exchange for a reduced interest rate on a mortgage loan. Each point typically costs 1% of the total mortgage loan amount and can lower the interest rate by a certain percentage, usually 0.25% or 0.5%. Discount rate. In real estate, the discount rate refers to the interest rate used to calculate the present value of future cash flows. This rate is used to determine the current value of an investment property by factoring in the time value of money and the risk associated with the investment. The discount rate can vary depending on factors such as the property's location, the investor's risk tolerance, and prevailing market conditions. Dispossess. Dispossess is a legal process whereby a landlord seeks to evict a tenant from the rented property. The dispossess process usually involves a court hearing and can only be carried out under specific circumstances, such as non-payment of rent or lease violations. Dominant tenement. In real estate, a dominant tenement refers to a property or estate that has the right to use an easement or other access over another property, known as a servient tenement. The dominant tenement has a legal right to access the servient tenement for specific purposes, such as a right-of-way to access a public road or an easement for utilities. Down payment. A down payment is the initial payment made by a buyer for a property or asset, usually a percentage of the total price. It is typically paid at the time of closing and is used to reduce the amount of the mortgage loan needed to finance the purchase. Dual agency. Dual agency is a situation in real estate where the same brokerage or agent represents both the buyer and seller in a transaction. In a dual agency scenario, The agent owns fiduciary duties to both parties and must ensure that there are no conflicts of interest. Due on sale. Due on sale refers to a clause in a mortgage or trust deed that requires the borrower to pay the full balance of the loan if the property is sold or transferred to another party. The purpose of the clause is to protect the lender's interest in the property and ensure that the borrower fulfills their obligation to repay the loan. Duress. Duress refers to the use of force or coercion to induce someone to act against their will. In real estate, duress may be used as a legal defense to a contract if it can be shown that one party was forced or coerced into signing the agreement. Earnest money. Earnest money is a deposit made by a buyer to show their good faith and commitment to completing a real estate transaction. This deposit is typically made at the time of the purchase agreement and is held in escrow until the closing of the transaction. The earnest money can be applied toward the down payment or closing cost of the property. Earnest money contract, EMC. An earnest money contract, EMC, is a legal document used in real estate transactions that outlines the terms and conditions of a sale, including the agreed-upon purchase price and the amount of earnest money being deposited. The EMC is typically accompanied by a purchase agreement and shows the buyer's commitment to purchase the property. If the sale goes through, the earnest money is applied to the purchase price, but if the sale falls through, the earnest money may be forfeited to the seller. Easement. An easement is a right to use a portion of another person's land for a specific purpose. The easement holder does not own the land, but has the legal right to use it as specified in the easement agreement. Easement by prescription. An easement by prescription is a legal right to use someone else's property for a specific purpose, acquired through continued use without the owner's permission for a certain period of time. The user must demonstrate open, notorious, continuous, and uninterrupted use of the property, typically for a period of at least 10 years. Economic obsolescence. Economic obsolescence refers to a reduction in the value of a property caused by external factors, such as changes in the surrounding area or the local economy, rather than physical deterioration of the property itself. This can include factors such as new developments that negatively impact the desirability of the property, changes in zoning regulations, or a decrease in demand for the property due to economic factors. Effective interest rate. The effective interest rate is the true cost of borrowing money, taking into account all the factors that affect the interest rate, such as compounding, fees, and charges. It is often used to compare different loan options and to determine the actual cost of a loan over time. Effluxion of time. Effluxion of time refers to the expiration of a legal right or interest, such as the end of a lease or the termination of an option. Once the period of time specified in the agreement has passed, the right or interest comes to an end automatically. Egress. In real estate, egress refers to the right or means of exiting a property or land, usually by way of a road or path. Egress can be an important factor to consider when evaluating the value and potential uses of a property. Emblements. Emblements are crops that are considered personal property and can be harvested by a tenant farmer or the owner of the land even after the lease or ownership of the land has ended. The right to emblements is often included in a lease agreement or may be granted by state law. Eminent domain. Eminent domain is the power of the government to take private property for public use, with just compensation paid to the property owner. This power is derived from the Fifth Amendment of the U.S. Constitution and is used to build public infrastructure such as roads, schools, and parks. Enclave community. An enclave community refers to a neighborhood or development that is physically surrounded by another city or neighborhood, but is not administratively a part of it. These communities are often distinct from their surrounding areas in terms of their architecture, lifestyle, and culture, and may be governed by their own homeowner association, HOA, or municipal authority. Examples of enclave communities include gated communities and planned communities. Encroachment. An encroachment is an unauthorized intrusion of a property owner's real estate onto another person's property. This can include anything from a fence or a building to overhanging branches or roots from a neighboring tree. Encroachments can lead to boundary disputes and may require legal action to resolve. Encumbrance. An encumbrance is a legal claim or liability against a property that can affect its transfer or use. Encumbrances can include mortgages, liens, easements, and other types of restrictions or obligations that limit the property owner's rights or impose financial obligations. Endorsement. In real estate, an endorsement is a written amendment or attachment to a document that modifies or adds to its provisions. Endorsements can be used to add or remove terms and conditions, to clarify the meaning of certain provisions, or to correct errors or omissions in the original document. Endorsements are commonly used in real estate to modify purchase agreements, lease agreements, and title insurance policies. Equal Credit Opportunity Act. The Equal Credit Opportunity Act, ECOA, is a federal law that prohibits discrimination in lending based on race, color, religion, national origin, sex, marital status, age, or receipt of public assistance. The law applies to all types of credit, including mortgages, car loans, credit cards, and personal loans. Lenders must provide applicants with a written notice of their rights under the ECOA and must consider all relevant factors when evaluating creditworthiness. Equal treatment/different impact. Equal treatment/different impact is a principle that prohibits discriminatory practices in real estate based on race, color, national origin, religion, sex, familial status, or disability. This principle applies to all aspects of real estate transactions, including advertising, marketing, and lending practices, and requires treating all individuals equally without regard to protected characteristics, even if the impact of certain practices may affect individuals differently. Equity. In real estate, equity refers to the difference between the market value of a property and the outstanding balance on any mortgages or liens. It represents the portion of the property's value that the owner actually owns outright and can be used to secure additional financing or sold to realize a profit. Escalator clause. An escalator clause is a provision in a contract that allows for an increase in price or rate based on a specified condition or index. In real estate, an escalator clause is commonly used in purchase offers to automatically increase the bid price if a higher offer is made by another buyer. Escheat. Escheat refers to the legal process by which the state takes ownership of a person's property when the person dies without leaving a will or without any known heirs. The state then becomes the custodian of the property until it can find the rightful owner or heir or dispose of the property through a public auction. Escrow. Escrow is a process in which a third party holds and regulates the exchange of funds and property between two parties involved in a real estate transaction. It ensures that both parties fulfill their obligations according to the terms of the agreement and that the transaction is completed smoothly and securely. The funds are held in an escrow account until all the conditions of the transaction are met and the transfer of property can be completed. Escrow account. An escrow account is a special account that is set up by a lender to hold funds, typically for property taxes and insurance, on behalf of a borrower. The lender collects a portion of the borrower's monthly mortgage payment to cover these expenses and deposits the funds into the escrow account. The funds are then paid out to the appropriate parties when the bills come due. Estimate of value. In real estate, an estimate of value refers to an appraiser's or broker's opinion of the current market value of a property. The estimate is usually based on a variety of factors, including recent comparable sales, location, condition of the property, and market trends. The estimate of value is an important tool for buyers and sellers as it helps them determine a fair price for the property. Et ux. It is often used in legal documents to indicate the spouse of a person, particularly in real estate transactions where both spouses have an interest in the property being bought or sold. Eviction. Eviction refers to the legal process of expelling a tenant from a property due to non-payment of rent, violation of lease terms, or expiration of the lease. It involves a court order and can result in the physical removal of the tenant and their belongings from the property. Exception. In real estate, an exception is a provision in a title insurance policy that excludes coverage for certain defects or claims. These exceptions can include things like liens, easements, or encroachments, and they are listed in the policy to clarify what is not covered. It is important to review these exceptions carefully before purchasing a property to ensure you understand the risks and limitations of your coverage. Exclusive agency, EA. Exclusive agency, EA, is a type of listing agreement in real estate where the seller agrees to work exclusively with one agent or brokerage to sell their property. However, the seller reserves the right to sell the property themselves without paying a commission to the listing agent, known as an exception to the agreement. If the property is sold through the agent, they receive a commission as per the terms of the agreement. Exclusive right to sell, ERS. Exclusive right to sell, ERS, is a type of real estate listing agreement in which the seller agrees to work exclusively with one real estate broker or agent to sell their property. In an ERS agreement, the broker or agent is guaranteed a commission even if the seller finds a buyer on their own or if another agent brings a buyer to the table. This type of agreement is commonly used in residential real estate transactions. Exculpatory clause. An exculpatory clause is a provision in a contract that excuses one party from liability for damages or injuries caused to the other party. In real estate, exculpatory clauses are commonly used in rental agreements and lease contracts to limit the landlord's liability for injuries or damages sustained by tenants. However, some jurisdictions may limit the enforceability of exculpatory clauses in certain situations. Executor/executrix. An executor or executrix is a person or entity named in a will to manage the affairs of the deceased person's estate. Their responsibilities include locating and valuing assets, paying debts and taxes, and distributing the estate to the beneficiaries named in the will. Expropriation. Expropriation refers to the process by which a government or other authorized entity takes private property for public use, usually with compensation paid to the property owner. Expropriation is a legal process that involves taking private property through eminent domain and is typically used to acquire land for public infrastructure projects such as roads, highways, and airports. Fair Housing Act and Fair Housing Amendments Act. The Fair Housing Act, FHA, and the Fair Housing Amendments Act, FHAA, are federal laws that prohibit housing discrimination based on race, color, religion, national origin, sex, disability, and familial status. The FHA was enacted in 1968, and the FHAA was passed in 1988 to provide additional protections against discrimination. These laws apply to a variety of housing-related activities, including renting, buying, financing, and advertising. Fair housing laws. Fair housing laws are a set of federal, state, and local laws that prohibit discrimination in housing based on race, color, religion, national origin, sex, familial status, and disability. These laws aim to ensure that all individuals have equal access to housing opportunities and are protected from discriminatory practices in the sale, rental, financing, and advertising of housing. Fannie Mae. Fannie Mae, also known as the Federal National Mortgage Association, FNMA, is a government-sponsored enterprise that provides liquidity to the mortgage market by purchasing and securitizing mortgages. Fannie Mae does not make loans directly to consumers, but instead buys loans from approved mortgage lenders and packages them into mortgage-backed securities to be sold to investors. FDIC. FDIC stands for Federal Deposit Insurance Corporation, which is a U.S. government agency that provides insurance for bank deposits in case the bank fails. The FDIC insures deposits up to a certain amount per depositor per bank, and it also helps to regulate and supervise U.S. banks to promote stability in the banking system. Federal Deposit Insurance Corporation, FDIC. The Federal Deposit Insurance Corporation, FDIC, is a United States government corporation established in 1933 as a result of the Great Depression. Its main purpose is to protect and insure deposits in banks and savings institutions. The FDIC guarantees deposits up to a certain amount, providing stability and confidence in the banking system. Federal Emergency Management Agency, FEMA, FEMA. The Federal Emergency Management Agency, FEMA, FEMA, is a United States government agency responsible for managing the federal government's response to natural disasters, including coordinated relief efforts, providing disaster assistance to individuals and businesses, and implementing mitigation strategies to reduce the risk of future disasters. FEMA is also responsible for administering the National Flood Insurance Program, NFIP, and providing training and support to emergency management professionals at the state and local level. Federal Home Loan Mortgage Corporation, FHLMC. The Federal Home Loan Mortgage Corporation, FHLMC, commonly known as Freddie Mac, is a government-sponsored enterprise that provides liquidity to the mortgage market. Its mission is to promote stability and affordability in the housing market by purchasing and securitizing mortgages from banks and other lenders. This helps to ensure that mortgage funds are available to home buyers at competitive rates. Federal Housing Administration. The Federal Housing Administration, FHA, is a government agency established in 1934 to improve housing conditions and home ownership opportunities for all Americans, particularly those with low or moderate income. The FHA provides mortgage insurance on loans made by FHA-approved lenders, enabling borrowers to get more favorable terms and helping more people become homeowners. Fee simple estate. Fee simple estate refers to an ownership interest in real property that gives the owner complete and unconditional ownership of the property, including the right to possess, use, and dispose of it as they wish. This type of ownership interest is often referred to as the highest form of ownership interest one can hold in real property. FHA. FHA stands for Federal Housing Administration, which is a government agency that provides mortgage insurance to lenders in order to make home ownership more accessible to low and moderate income borrowers. FHA loans have lower down payment requirements and more flexible credit standards than conventional loans, but they also come with certain limitations and fees. FHLMC. FHLMC stands for Federal Home Loan Mortgage Corporation, also known as Freddie Mac. It is a government-sponsored enterprise that buys and sells mortgages in the secondary mortgage market, providing liquidity for lenders and enabling more people to become homeowners. Fiduciary. A fiduciary is an individual or organization that is legally and ethically bound to act in the best interest of another party, typically a client or beneficiary. In real estate, a fiduciary relationship is often formed between a real estate agent and their client, where the agent is responsible for representing the client's interest in a real estate transaction. This includes duties such as loyalty, confidentiality, full disclosure, and reasonable care and diligence. Finder's fee. A finder's fee is a commission paid to a person who helps facilitate a business transaction, typically by introducing potential customers or business partners to a company. In real estate, a finder's fee may be paid to a person who helps a buyer find a suitable property or a seller find a potential buyer. The amount of the finder's fee is typically agreed upon in advance and is usually a percentage of the total transaction amount. First mortgage. A first mortgage refers to a primary lien on a property that takes priority over any other liens or claims against the property. This means that if the property is sold or foreclosed upon, the first mortgage must be paid off before any other debts or claims can be satisfied. Fixed-rate mortgage. A fixed-rate mortgage is a type of mortgage where the interest rate remains the same for the entire term of the loan, which is typically 15 or 30 years. This means that the borrower's monthly principal and interest payments will remain the same over the life of the loan, providing stability and predictability in their housing costs. Fixture. A fixture is an item that was once personal property but has become real property by being permanently attached to the land or a building. Examples of fixtures include built-in cabinets, light fixtures, and HVAC systems. The determination of whether an item is a fixture or personal property can depend on factors such as the manner of attachment and the intention of the parties. Flood Control District. A flood control district is a governmental entity responsible for managing and reducing the risk of flood damage in a specific geographic area. Its primary responsibility is to implement and maintain flood control measures such as dams, levees, and drainage systems, and to provide emergency response services during flooding events. Flood control districts may be established at the county, city, or regional level, depending on the location and scope of the area in question. Flood insurance. Flood insurance is a type of insurance that provides coverage for property damage caused by flooding. It is typically required by mortgage lenders in areas that are at high risk of flooding and is often provided through the National Flood Insurance Program, NFIP. Floodplain. A floodplain is a flat area adjacent to a river or stream that is susceptible to flooding during times of heavy rain or snowmelt. Floodplains are important to identify in real estate because they can pose a risk of property damage and safety hazards to homeowners and buyers. Flood insurance is often required in floodplains, and properties located in flood-prone areas may be subject to additional building codes and regulations. FNMA. FNMA, or Federal National Mortgage Association, is a government-sponsored enterprise that purchases and securitizes mortgages, helping to ensure the availability and affordability of home loans in the United States. FNMA operates in the secondary mortgage market, buying loans from primary lenders and then packaging them into securities for sale to investors. For sale by owner, FSBO. For sale by owner, FSBO, is a real estate term used to describe when a property owner decides to sell their property without the representation of a real estate agent. The property owner is responsible for all aspects of the sale, from pricing the property to negotiating with potential buyers. Foreclosure. Foreclosure is a legal process in which a lender seeks to recover the outstanding balance of a loan by forcing the sale of the property that was used as collateral for the loan. This typically occurs when the borrower defaults on the loan, meaning they have failed to make the required payments. Foreclosure can result in the borrower losing their home and the lender taking ownership of the property. Forfeiture. Forfeiture refers to the loss of property or assets as a penalty for some illegal or prohibited act. In real estate, forfeiture can occur if a property owner fails to meet their contractual obligations or pay taxes or mortgages, resulting in the forfeiture of the property to the lender or government. Fraud. In real estate, fraud refers to intentionally deceiving someone in order to gain an unfair or unlawful advantage. This can include misrepresenting information about a property, such as its value or condition, or engaging in other dishonest practices during the buying or selling process. Fraud can lead to legal consequences and financial losses for those involved. Freddie Mac. Freddie Mac, or the Federal Home Loan Mortgage Corporation, is a government-sponsored enterprise that buys and securitizes mortgages, providing liquidity to the mortgage market. It was established in 1970 to increase home ownership and affordability by supporting the secondary mortgage market. Front foot. In real estate, the term front foot refers to the length of a property that faces the street or waterway and is typically used to determine the cost of public services such as sewer, water, and other utilities. The front footage of a property can be measured in linear feet or square feet, depending on the jurisdiction and local regulations. FSBO. FSBO stands for sale by owner, which refers to a property that is being sold directly by the owner without the use of a real estate agent or broker. In an FSBO transaction, the owner is responsible for all aspects of the sale, including advertising, showing the property, negotiating with buyers, and preparing the necessary legal documents. Functional obsolescence. Functional obsolescence is a decrease in the value of a property due to outdated or inadequate features, design, or layout. This can include issues like poor floor plans, outdated technology, or inefficient use of space that negatively impact the property's functionality and overall value. Garden home. A garden home is a type of attached or detached residential dwelling that typically features a small yard or garden area for private outdoor use. These homes are often designed to be low maintenance and efficient in their use of space, and may be popular options for individuals or families looking for a more affordable or manageable living situation. Gated community. A gated community refers to a residential neighborhood or community that is enclosed by a physical barrier such as walls, fences, or gates, which are often manned by security personnel. This type of community is typically exclusive and provides a high level of security and privacy for its residents. General lien. A general lien is a type of lien that gives the creditor the right to take possession of and sell any property owned by the debtor to satisfy a debt, regardless of when the debt was incurred. General liens are typically granted to secured creditors, such as mortgage lenders or those who have obtained a judgment against a debtor. General warranty deed. A general warranty deed is a legal document used to transfer real estate from one party to another. It contains a guarantee from the seller that they have the legal right to sell the property, that there are no undisclosed liens or encumbrances, and that the buyer will receive clear title to the property. The warranty covers the entire history of the property, providing the buyer with maximum protection against any potential defects in title. Ginnie Mae. Ginnie Mae, GNMA, is a U.S. government corporation within the Department of Housing and Urban Development, HUD, that provides support to the secondary market for residential mortgages. Ginnie Mae guarantees mortgage-backed securities, MBS, backed by federally insured or guaranteed loans, including those backed by the Federal Housing Administration, FHA, Department of Veterans Affairs, VA, and the Department of Agriculture's Rural Housing Service, RHS. Government National Mortgage Association. The Government National Mortgage Association, also known as Ginnie Mae, is a U.S. government-owned corporation within the Department of Housing and Urban Development. Ginnie Mae guarantees mortgage-backed securities that are issued by approved lenders and backed by mortgages insured or guaranteed by the Federal Housing Administration, the Department of Veterans Affairs, and other government entities. GNMA. GNMA stands for the Government National Mortgage Association, which is a U.S. government agency that provides liquidity to the secondary mortgage market by purchasing mortgages from lenders. GNMA is also known as Ginnie Mae, and its primary mission is to support homeownership for low to moderate income families and facilitate affordable mortgage financing options. Good faith estimate. A good faith estimate, GFE, is a document provided by a mortgage lender to a borrower that outlines the estimated cost associated with obtaining a mortgage. The GFE includes estimates for the loan origination fees, title fees, appraisal fees, and other costs associated with obtaining a mortgage. Government survey method. The government survey method is a system of land surveying used in the United States to divide and describe land parcels. This method was established in the late 18th century to survey and sell public lands acquired by the federal government, and it uses a rectangular system based on a grid of principal meridians and baselines. Grace period. A grace period is a period of time after a payment is due, during which the payment can be made without incurring penalties or late fees. In the context of real estate, a grace period may be included in a mortgage or rental agreement, allowing the borrower or tenant some extra time to make their payment without incurring a penalty. The length of the grace period can vary depending on the terms of the agreement. Grant deed. A grant deed is a legal document used to transfer ownership of real property from one party to another. It contains the name and address of the grantor, seller, the name and address of the grantee, buyer, a legal description of the property, and any restrictions or encumbrances on the property. Grantee. In real estate, a grantee is the recipient of a property right, title, or interest conveyed by a grantor through a legal document such as a deed or a will. The grantee is typically the buyer or recipient of the property, while the grantor is the seller or donor of the property. The grantee has legal rights and responsibilities related to the property, such as paying property taxes and complying with local zoning regulations. Grantor. In real estate, a grantor refers to the person or entity that transfers ownership of real property to another party, known as the grantee. The grantor is typically the current owner of the property and executes a legal document, such as a deed, to convey title to the grantee. Gross debt service. Gross debt service, GDS, refers to the ratio of a borrower's total housing-related expenses, including principal, interest, property taxes, and heating expenses, to their gross annual income. It is a key metric used by lenders to assess a borrower's ability to make mortgage payments and manage their debt. A lower GDS ratio indicates better financial health and a greater likelihood of loan approval. Gross income. Gross income in real estate refers to the total amount of income earned from a property before any deductions or expenses are taken into account. This can include rental income, fees, and other sources of revenue related to the property. Gross income is an important metric used by investors to assess the potential profitability of a real estate investment. Gross lease. A gross lease is a type of commercial lease where the tenant pays a fixed amount of rent and the landlord is responsible for paying all operating expenses, including property taxes, insurance, and maintenance costs. This type of lease is often used for single-tenant buildings or for smaller tenants who cannot afford to pay additional expenses. Gross leases offer tenants a predictable and stable rent payment, while landlords have more control over the property's expenses. Habendum clause. A habendum clause is a provision in a real estate deed that defines the ownership interest being conveyed. It typically includes language such as to have and to hold, and specifies the type of ownership interest being granted, such as fee simple or life estate. The habendum clause is a crucial part of a deed as it clarifies the extent of the new owner's rights and responsibilities. Hazard insurance. Hazard insurance is a type of insurance coverage that protects homeowners against damage or loss to their property caused by specific perils such as fire, theft, and natural disasters. Hazard insurance is typically required by mortgage lenders as a condition of the loan to ensure that the property is adequately protected against potential hazards. The coverage and cost of hazard insurance can vary depending on the location and value of the property. Hereditaments. Hereditaments are any inheritable property, whether tangible or intangible, that can be passed down to heirs through a will or by law. In real estate, hereditaments include land, buildings, and any associated rights, such as easements or mineral rights, that can be inherited or passed on to future generations. The concept of hereditaments is an important aspect of property law and estate planning. High-rise. A high-rise is a tall building typically characterized by having 10 or more floors. High-rises are often found in urban areas and are used for a variety of purposes, including commercial, residential, and mixed-use developments. The construction and operation of high-rise buildings require specialized engineering and safety measures to ensure the safety and comfort of occupants. Highest and best use. Highest and best use is a principle in real estate that determines the most profitable and optimal use of a property that is legally and physically possible, financially feasible, and maximizes its value. The concept takes into account factors such as zoning, market demand, and the property's physical characteristics to determine the most suitable use of the property, whether it be for residential, commercial, or other purposes. HOA. HOA stands for Homeowners Association, which is a legal entity created by a real estate developer to manage and maintain a planned community, such as a condominium or a neighborhood of single-family homes. Members of an HOA are typically required to pay fees to cover the cost of maintaining common areas, enforcing rules and regulations, and providing amenities and services. HOAs can have significant authority over their members, including the ability to levy fines and place liens on properties that do not comply with their rules. Hold harmless. Hold harmless is a legal agreement between two parties where one party agrees to protect the other party from any legal claims, damages, or losses that may arise from a specific activity, transaction, or relationship between them. It is often used in real estate contracts to shift the risk of potential liabilities from one party to another. Home equity loan. A home equity loan is a type of loan where the borrower uses the equity in their home as collateral. The loan amount is based on the difference between the current value of the home and the amount still owed on the mortgage. The borrower receives a lump sum of money, which they can use for various purposes, and they are required to make regular payments with interest over a fixed period. Home warranty. A home warranty is a type of service contract that covers the repair or replacement of major home systems and appliances that may break down due to normal wear and tear. The warranty typically lasts for a set period, such as 1 year, and the homeowner pays an annual fee for the coverage. Home warranties can provide peace of mind and financial protection to homeowners in case of unexpected breakdowns. Homeowners Association, HOA. A homeowners association, HOA, is an organization created by a real estate developer or community to manage and maintain common areas, amenities, and services in a residential development or condominium complex. Homeowners are required to pay dues or fees to the HOA, which is responsible for enforcing rules and regulations related to property use, maintenance, and appearance. HOAs can provide benefits such as community upkeep and neighborhood amenities, but they can also restrict homeowners' freedom and add additional expenses to home ownership. Homeowners insurance. Homeowners insurance is a type of insurance policy that provides financial protection to homeowners in case of damage to their property or personal belongings. The policy typically covers events such as fire, theft, vandalism, and natural disasters, as well as liability for accidents that may occur on the property. Homeowners insurance is usually required by mortgage lenders and can provide peace of mind and financial security to homeowners. Homestead. Homestead refers to a legal provision that allows homeowners to protect their primary residence from certain creditors or legal actions. Homestead laws vary by state, but they generally provide a designated amount of equity protection for the home, which can help prevent the forced sale of the property to satisfy debts or judgments. Homestead can provide important protections to homeowners and their families, particularly in times of financial difficulty. House closing. House closing, also known as settlement or completion, is the final step in the home buying process. where the buyer and seller sign all the necessary legal documents and transfer ownership of the property. During the closing, the buyer pays the remaining balance of the purchase price, and the seller transfers the title and keys to the property. The closing is typically attended by the buyer, seller, real estate agents, attorneys, and other parties involved in the transaction. Housing and Urban Development, Department of HUD. The Department of Housing and Urban Development, HUD, is a U.S. government agency responsible for developing and implementing policies related to housing and urban development. The agency works to create affordable housing, improve access to home ownership, promote economic development, and enforce fair housing laws. HUD also provides resources and assistance to individuals and communities affected by natural disasters and other housing emergencies. HUD stands for the Department of Housing and Urban Development, a U.S. government agency that oversees policies and programs related to housing and urban development. The agency is responsible for ensuring access to affordable housing, promoting economic development, and enforcing fair housing laws. HUD also provides resources and assistance to individuals and communities affected by housing emergencies and natural disasters. Implied warranty of habitability. Implied warranty of habitability is a legal concept that holds landlords responsible for providing rental properties that are safe, sanitary, and fit for human habitation. This means that the landlord is obligated to maintain the property in a livable condition and make necessary repairs to keep it in compliance with building and housing codes. Improvements. Improvements refer to any modifications or additions made to a property that enhance its value or utility. This can include structural changes like adding a new room or upgrading the plumbing, as well as aesthetic improvements such as landscaping or remodeling the kitchen. Improvements are often made to increase the market value of a property or to make it more functional for its intended use. Incidents of ownership. Incidents of ownership refer to the rights and privileges associated with owning a property, such as the right to occupy, use, sell, or transfer the property. These incidents can be separated or shared among different parties depending on the ownership structure of the property and can have important implications for legal and financial responsibilities related to the property. Income approach to value. The income approach to value is a method used to estimate the value of an income-producing property, such as an apartment complex or office building, based on the net income it generates. This approach involves calculating the potential future income of the property, subtracting expenses and a reserve for replacement costs, and applying a capitalization rate to arrive at an estimated value. The income approach is often used in conjunction with other valuation methods to provide a comprehensive estimate of a property's worth. Index. In real estate, an index is a benchmark used to measure changes in the value of a particular market or property. Indices can be based on various factors, such as the price of similar properties, interest rates, or economic indicators, and are often used to track trends in the real estate market over time. Investors and appraisers may use indices to make informed decisions about buying or selling property. Ingress. Ingress refers to the right to enter a property from a public or private road or pathway. This can include the right to access a driveway, walkway, or other means of entry. The right of ingress is often included in property deeds and can be subject to legal restrictions or limitations. Inspection clause. An inspection clause is a provision in a real estate contract that allows the buyer to conduct an inspection of the property before finalizing the sale. This clause typically specifies the type of inspection to be conducted, the time frame for completing the inspection, and any conditions or contingencies that may arise as a result of the inspection. The inspection clause is designed to protect the buyer by ensuring that they are aware of any potential issues or defects with the property before completing the transaction. Insurable title. Insurable title refers to a property title that is considered by a title insurance company to be free from defects, liens, and other encumbrances that could affect the ownership or transferability of the property. A property with an insurable title is generally considered to be marketable, which means it can be sold or transferred without any significant legal or financial barriers. Interest. In real estate, interest refers to the cost of borrowing money, usually expressed as a percentage of the total loan amount. When a borrower takes out a mortgage to buy a property, they agree to pay interest on the loan to the lender over a specified period of time, which can significantly affect the total amount of money paid back over the life of the loan. Interest rates can vary depending on market conditions, the borrower's creditworthiness, and other factors. Interest. In real estate, interest refers to the cost of borrowing money, usually expressed as a percentage of the total loan amount. When a borrower takes out a mortgage to buy a property, they agree to pay interest on the loan to the lender over a specified period of time, which can significantly affect the total amount of money paid back over the life of the loan. Interest rates can vary depending on market conditions, the borrower's creditworthiness, and other factors. Interest rate. Interest rate refers to the percentage of the loan amount that a lender charges a borrower for the use of money over a specified period of time. In real estate, interest rates are typically associated with mortgages where a borrower agrees to pay back the loan amount plus interest over the life of the loan. Interest rates can vary depending on the factors such as market conditions, inflation, and the borrower's credit score. Intestate. Intestate refers to the situation where a person dies without leaving a valid will or testamentary document. In real estate, when a person dies intestate, their property is typically distributed according to the laws of the state where the property is located, which may involve a court-supervised probate process. Intimidation. In real estate, intimidation refers to any behavior or action that is intended to coerce, pressure, or threaten someone into taking a specific action related to a property transaction. This can include tactics such as verbal abuse, harassment, or physical violence, and is generally considered unethical and illegal. Intimidation can have a significant impact on the outcome of a real estate transaction and can lead to legal and financial consequences for those involved. Invitee. An invitee is a person who is invited onto a property by the owner or occupier for a specific purpose, such as a customer visiting a store or a guest attending a party. In real estate, the legal status of an invitee can affect the owner or occupier's duty of care and liability in the event of an injury or accident on the property. Generally, the owner or occupier owes a higher duty of care to invitees compared to trespassers or licensees. Joint tenancy. Joint tenancy is a form of property ownership where two or more individuals hold an equal and undivided interest in a property with the right of survivorship. This means that if one of the joint tenants dies, their share of the property automatically transfers to the surviving joint tenants without the need for probate. Joint tenancy is often used by couples or family members who want to ensure that their share of the property goes to the other joint tenants upon their death. Judgment. In real estate, a judgment is a legal decision or court order that requires a person or entity to pay a debt or perform a specific action. A judgment can be obtained by a creditor or other party who is owed money and can result in a lien or other legal claim on the debtor's property, including real estate. A judgment can affect a person's ability to buy or sell property and may also impact their credit score and financial standing. Lashes. Lashes is a legal doctrine that may be used to prevent a party from bringing a claim or seeking a remedy if they have unreasonably delayed in asserting their rights. In real estate, lashes may arise in situations where a property owner fails to take legal action to protect their property rights in a timely manner, such as waiting too long to address a neighbor's encroachment on their property. A court may use lashes as a basis for denying relief to a party who has waited too long to assert their legal rights, even if their claim is otherwise valid. Landlord. A landlord is a person or entity who owns and rents out property to a tenant in exchange for rent payments. In real estate, landlords can be individuals, corporations, or other legal entities, and may own a variety of properties, including residential, commercial, and industrial real estate. Landlords have certain legal obligations and responsibilities to their tenants, such as maintaining the property in a habitable condition and providing necessary repairs and maintenance. Latent defect. A latent defect is a hidden or non-apparent defect in a property that is not readily observable through a reasonable inspection. In real estate, latent defects may include issues such as a structural defect or a problem with the property's plumbing or electrical systems. If a latent defect is discovered after the sale of a property, the buyer may be able to seek legal remedies against the seller. Lease. A lease is a legal agreement between a property owner, the landlord, and a tenant, in which the landlord grants the tenant the right to occupy and use the property in exchange for rent payments. In real estate, leases can be used for both residential and commercial properties and can vary in length from a few months to several years. Leases typically outline the terms and conditions of the tenancy, including the amount of rent, the length of the lease, and the rights and responsibilities of both the landlord and tenant. Lease option. A lease option, also known as a rent-to-own agreement, is a type of lease that gives the tenant the option to purchase the property at the end of the lease term. In a lease option, a portion of the rent payments made by the tenant is applied towards the purchase price of the property, and the tenant typically has the option to exercise their right to purchase the property at any time during the lease term. Lease options can be beneficial for both landlords and tenants, as they offer flexibility and the opportunity for the tenant to become a homeowner. Lease purchase. A lease purchase is a type of real estate transaction in which the buyer leases the property from the seller for a set period of time, with the option to purchase the property at the end of the lease term. Unlike a lease option, a lease purchase agreement requires the buyer to purchase the property at the end of the lease term, regardless of whether they decide to exercise their option to buy. Lease purchases can be beneficial for buyers who are not yet able to obtain traditional financing but still want to secure a home for themselves in the future. Leasehold estate. A leasehold estate is a type of real estate ownership in which a tenant holds a lease for a specific period of time, typically several years or more. In a leasehold estate, the tenant has the right to occupy and use the property for the duration of the lease, but does not own the property outright. Leasehold estates can be used for both residential and commercial properties and are common in areas where land is scarce or expensive. Legal description. A legal description is a written description of a specific piece of real estate that accurately and uniquely identifies the property for legal and recording purposes. Legal descriptions are typically used in real estate transactions and legal documents and can be based on a variety of factors, including the property's location, boundaries, and physical features. Examples of legal descriptions include Mets and Bounds descriptions, lot and block descriptions, and government survey descriptions. Less favorable treatment. Less favorable treatment refers to any kind of discriminatory treatment in real estate based on certain protected characteristics such as race, color, national origin, religion, sex, familial status, and disability. Examples of less favorable treatment can include refusing to sell or rent a property, providing different terms or conditions, or offering different services based on a protected characteristic. Less favorable treatment is illegal under fair housing laws and can result in significant legal consequences for violators. Lessee. A lessee is a person or entity who rents or leases a property from a landlord or lessor. In a lease agreement, the lessee is granted the right to use and occupy the property for a specific period of time in exchange for payment of rent. Lessees can be individuals, businesses, or organizations and can enter into various types of lease agreements, such as residential leases, commercial leases, and ground leases. Lessor. A lessor is a person or entity who owns a property and leases or rents it to another person or entity, known as the lessee. The lessor is responsible for maintaining the property and ensuring that it meets all applicable legal requirements, while the lessee is responsible for paying rent and complying with the terms of the lease agreement. Lessor responsibilities can vary depending on the type of property being leased and may include things like collecting rent, handling repairs, and providing necessary disclosures to tenants. Leverage. Leverage in real estate refers to the use of borrowed funds or other financial instruments to increase the potential return on an investment. By using leverage, investors can increase their purchasing power and acquire properties that they might not have been able to afford otherwise. However, leverage can also increase risk as it magnifies both gains and losses. Levy Improvement District, LID, LID. A levy improvement district, LID, is a type of special taxing district that is created to fund public improvements and services within a designated area. LIDs are typically formed to finance infrastructure projects, such as roads, sidewalks, and water and sewer systems, and are funded by special assessments on property owners within the district. Property owners may have a say in the formation and management of LIDs, and the funds collected are typically used for specific improvements within the district. Licensee. A licensee is a person who is licensed to engage in a particular activity, such as selling or leasing real estate. In the context of real estate, a licensee is someone who holds a valid license to practice real estate in a particular jurisdiction and is authorized to act as an agent or representative for clients in transactions related to buying, selling, or leasing real estate. Licensees are typically required to meet certain educational and professional requirements and are subject to regulation and oversight by state licensing authorities. LID. LID stands for Local Improvement District, which is a type of special taxing district that is established to fund public improvements and services within a designated area. Lids are typically created to finance infrastructure projects such as roads, sidewalks, and water and sewer systems, and are funded by special assessments on property owners within the district. The funds collected from the assessments are used to pay for specific improvements within the district, and property owners may have a say in the formation and management of the lid. Lien. A lien is a legal claim or encumbrance that one party has over the property of another party, typically as a result of unpaid debt or obligation. The holder of a lien has a right to seize or sell the property in order to satisfy the debt or obligation owed to them. Examples of liens in real estate include mortgage liens, tax liens, and mechanics liens. Lien theory state. A lien theory state is a state in which the mortgage lender holds a lien on the property as collateral for the loan rather than holding the title to the property. In a lien theory state, the borrower retains legal title to the property while the lender has a lien on the property until the loan is paid off. The majority of states in the United States are lien theory states. Life estate. A life estate is a type of estate in real property that grants a person, called the life tenant, the right to use and enjoy a property for the duration of their lifetime. Upon the life tenant's death, ownership of the property passes to a remainder man, who is typically designated in the original grant of the life estate. The life tenant has certain responsibilities and limitations on their use of the property, and they cannot sell or transfer the property without the consent of the remainder man. Life tenant. A life tenant is a person who holds a life estate, which is a type of estate in real property that grants them the right to use and enjoy a property for the duration of their lifetime. The life tenant has certain responsibilities and limitations on their use of the property, and they cannot sell or transfer the property without the consent of the remainder man, who is the designated owner of the property upon the life tenant's death. Limited equity housing. Limited equity housing refers to a type of affordable housing that is designed to be affordable to low and moderate income households by restricting the amount of equity that owners can accumulate in their units. This is typically achieved through resale restrictions and other mechanisms that ensure that the units remain affordable over time and are often found in cooperative housing developments or community land trusts. Lease pendens. Lease pendens is a legal document that indicates that a lawsuit has been filed against a property and that the property's title is in dispute. It serves as a public notice of the pending legal action and can affect the ability to sell or transfer the property until the lawsuit is resolved. Listing agreement. A listing agreement is a contract between a property owner and a licensed real estate agent that outlines the terms and conditions for marketing and selling the property. It typically includes the listing price, commission rates, the duration of the agreement, and any other relevant details. Loan-to-value ratio, LTV. Loan-to-value ratio, LTV, is a financial term that is commonly used in real estate. It is the ratio of the loan amount to the appraised value or purchase price of the property. Lenders use the LTV ratio to assess the risk associated with a loan and to determine the amount of the loan that they are willing to provide to a borrower. Lock or lock-in. In real estate, a lock or lock-in refers to the process of securing an interest rate on a mortgage loan. This typically occurs after a borrower completes a loan application and provides supporting documentation to the lender. Once a rate is locked, it will remain in place until the loan closes, protecting the borrower from potential interest rate increases. Loft. A loft is a large, open living space that is usually converted from an industrial or commercial building. Typically characterized by high ceilings, large windows, and exposed brick or concrete walls, lofts are often associated with urban living and have become popular housing options for artists, designers, and other creative professionals. LTV. LTV, or loan-to-value ratio, is a financial term used in real estate that expresses the ratio of a loan amount to the appraised value of the property being financed. The LTV ratio is an important factor in determining the amount of the loan and the interest rate that a lender is willing to offer. A high LTV ratio indicates a greater risk to the lender, which may result in a higher interest rate or additional requirements for the borrower. Manufactured home. A manufactured home, also known as a mobile home, is a prefabricated home that is built in a factory and then transported to a designated site for installation. These homes are designed to meet the same building codes and standards as traditional site-built homes, but are often less expensive and can be more quickly constructed. They are typically placed on a permanent foundation and can range in size and style from single-wide to multi-section homes. Margin. In real estate, margin is the difference between the interest rate of a loan and the index it is based on. The margin represents the lender's profit and is added to the index to determine the final interest rate for the borrower. Marginal land. Marginal land refers to land that has poor soil quality, limited access to water, or other undesirable conditions that make it difficult or impossible to use for agricultural or other productive purposes. Marginal land may be used for grazing, wildlife habitat, or other purposes that do not require intensive cultivation. Market approach to value. The market approach to value is a real estate valuation method that uses sales data of comparable properties to determine the value of a property. This approach assumes that the value of a property is influenced by the prices at which similar properties have recently sold in the same or similar market. Market value. Market value is the estimated value of a property based on current economic conditions, comparable sales, and other relevant factors. It is the price that a willing and informed buyer would pay and a willing and informed seller would accept in an arm's-length transaction. Master planned community. A master planned community is a type of residential development that incorporates a wide range of amenities and services within a single community. These amenities can include things like parks, playgrounds, schools, shopping centers, and other facilities, all designed to create a self-contained and cohesive living environment for residents. Master planned communities are typically developed with a long-term vision in mind and can be quite large, spanning hundreds or even thousands of acres. MCE. MCE stands for Mandatory Continuing Education. In real estate, MCE refers to the education and training that licensed agents and brokers are required to complete in order to maintain their license and stay up to date on industry regulations and best practices. The specific requirements for MCE can vary by state or jurisdiction. Mechanics lien. A mechanics lien is a legal claim placed on a property by a contractor, subcontractor, or supplier who has provided labor or materials but has not been paid for their work. The lien serves as security for payment and can prevent the property from being sold or refinanced until the debt is satisfied. Mediation. Mediation is a form of dispute resolution that involves a neutral third party, called a mediator, who helps parties in a disagreement reach a mutually acceptable solution. In the context of real estate, mediation can be used to resolve disputes related to purchase agreements, lease agreements, construction contracts, and other real estate transactions. The mediator does not make decisions for the parties, but facilitates communication and negotiation to help them reach a resolution. Mates and bounds. Mates and bounds is a legal description method used to describe the boundaries of a parcel of land. It involves identifying a starting point and then using a series of measurements and boundary markers to describe the shape and location of the property. Mid-rise. A mid-rise is a building that is taller than a low-rise, but not as tall as a high-rise. Typically, a mid-rise building is between 5 and 10 stories tall and is often found in urban or suburban areas. Mineral rights. Mineral rights refer to the ownership of subsurface resources such as oil, gas, minerals, and other geological materials. In real estate, mineral rights can be severed or conveyed separately from the surface rights, which can lead to complex legal and financial issues. Minimum payment. Minimum payment refers to the smallest amount of money that a borrower must pay towards their outstanding balance on a loan or credit card in order to avoid defaulting on their payment obligation. This payment is typically determined by the lender and is usually calculated as a percentage of the total balance owed. Minority. In real estate, the term minority refers to a group of people who belong to a race, ethnicity, or culture that is not in the majority in a particular region or community. The term is often used in the context of fair housing laws, which prohibit discrimination based on race, color, religion, sex, national origin, familial status, or disability. Real estate professionals must adhere to these laws and ensure that all individuals are treated fairly and equally in the buying, selling, renting, and financing of property. Misrepresentation. Misrepresentation refers to the act of providing false or misleading information about a property or transaction in order to deceive or mislead a buyer, seller, or other party involved in a real estate transaction. This can include making false statements about the condition or value of a property, withholding important information, or altering documents to create a false impression. Misrepresentation is a serious violation of real estate law and can result in legal consequences for the offending party. Mobile home. A mobile home is a type of prefabricated dwelling that is designed to be transported on a trailer or chassis. Mobile homes are often used as permanent residences and are available in a range of sizes and styles to suit different needs and budgets. They are regulated by federal and state laws and may require permits and inspections for installation and occupancy. Month-to-month tenancy. A month-to-month tenancy is a type of rental agreement that allows the tenant to occupy a property on a month-by-month basis without a fixed-term lease. This type of tenancy is typically used for short-term rentals or when the landlord and tenant prefer the flexibility of a month-to-month arrangement. Either party can terminate the tenancy with proper notice, usually 30 days, without having to break a lease. Monument. In real estate, a monument refers to a permanent physical marker or structure that is used to identify a specific property or boundary. Monuments can be made of various materials, such as concrete, stone, or metal, and are often placed at the corners of a property to mark the boundaries. They can also be used to denote important landmarks, such as entrances or historical sites. Mortgage. A mortgage is a type of loan that is used to finance the purchase of real estate, such as a house or land. The borrower, mortgagor, pledges the property as collateral for the loan and agrees to repay the loan over a set period of time with interest. If the borrower defaults on the loan, the lender, mortgagee, may foreclose on the property and sell it to recover their investment. Mortgage banker. A mortgage banker is a financial institution that originates and funds mortgage loans and then either keeps the loans in their portfolio or sells them to investors. Mortgage bankers may also service the loans they originate, which involves collecting payments from borrowers and managing the loan throughout its term. They are regulated by federal and state laws and must follow strict underwriting guidelines to ensure the loans they make are secure and profitable. Mortgage broker. A mortgage broker is a licensed professional who acts as an intermediary between borrowers and lenders to help facilitate mortgage loans. Mortgage brokers work with a variety of lenders to find the best loan options for their clients, and they typically earn a commission on the loans they arrange. They may provide advice and guidance to borrowers throughout the loan process and help them complete the necessary paperwork. Mortgage loan. A mortgage loan is a type of loan that is used to finance the purchase of real estate. The borrower, mortgagor, pledges the property as collateral for the loan and agrees to repay the loan over a set period of time with interest. Mortgage loans are typically offered by banks, credit unions, and other financial institutions and may have varying terms, interest rates, and payment schedules. Mortgagee. The mortgagee is the lender or financial institution that provides a mortgage loan to a borrower, mortgagor, to finance the purchase of real estate. The mortgagee holds a security interest in the property and has the right to foreclose on the property if the borrower defaults on the loan. The mortgagee typically receives interest payments on the loan and may sell the loan to other investors. Mortgagor. The mortgagor is the borrower who obtains a mortgage loan from a lender or financial institution to finance the purchase of real estate. The mortgagor pledges the property as collateral for the loan and agrees to repay the loan over a set period of time with interest. If the mortgagor defaults on the loan, the lender, mortgagee, may foreclose on the property and sell it to recover their investment. MUD. In real estate, MUD stands for Municipal Utility District, which is a special purpose district created by the Texas State Legislature to provide essential services such as water, sewage, and drainage to communities that are not served by a municipality. MUDs are governed by a board of directors elected by the residents of the district and may issue bonds to finance the construction and maintenance of infrastructure. Multiple Listing Service, MLS. The Multiple Listing Service, MLS, is a database of real estate listings that is used by real estate agents and brokers to share information about properties for sale or lease. The MLS is a cooperative system that allows members to access and share information about properties, including listing price, property features, and other details. By sharing information through the MLS, real estate agents can expand their reach and offer their clients a wider selection of properties to choose from. Negative amortization. Negative amortization occurs when the payment on a loan is not sufficient to cover the interest that is due, resulting in the unpaid interest being added to the principal balance of the loan. This means that the outstanding balance of the loan may increase over time rather than decrease, and the borrower may end up owing more than they originally borrowed. Negative amortization is commonly associated with certain types of mortgage loans, such as adjustable rate mortgages, ARMs, that have low initial interest rates that can increase over time. Net lease. A net lease is a type of lease agreement where the tenant is responsible for paying a portion or all of the property's operating expenses, such as property taxes, insurance, and maintenance cost, in addition to their base rent. The terms of a net lease may vary depending on the specific agreement between the landlord and tenant, but generally the tenant assumes a greater degree of financial responsibility for the property compared to other types of leases. Net listing. A net listing is a type of listing agreement between a seller and a real estate agent where the agent's commission is based on the amount by which the sale price exceeds a certain minimum price set by the seller. In a net listing, the agent's incentive is to sell the property for as much as possible to maximize their commission, which can create a potential conflict of interest with the seller's best interest. Due to this potential conflict, net listings are illegal in some states and are discouraged in others. Non-escrowing loan. A non-escrowing loan is a mortgage loan in which the borrower is responsible for paying their property taxes and insurance directly, rather than having these expenses included in their monthly mortgage payment and held in an escrow account by the lender. With a non-escrowing loan, the borrower must ensure that they have enough funds available to make these payments when they are due, and may be subject to penalties or fees if they are not paid on time. Non-escrowing loans may be an option for borrowers who prefer to manage their own finances and have a stable source of income to cover their property expenses. Note: in real estate, a note refers to a written agreement that outlines the terms of a loan and the borrower's obligation to repay the loan. The note includes details such as the loan amount, interest rate, repayment schedule, and any penalties for late payments or default. The note may be secured by a mortgage or other form of collateral and may be bought and sold by investors on the secondary market. Nuisance. In real estate, a nuisance is a condition or activity on a property that interferes with the use or enjoyment of neighboring properties. A nuisance can take many forms, such as noise, odor, pollution, or visual blight, and can be caused by both natural and man-made factors. In legal terms, a nuisance can be grounds for a lawsuit or other legal action to seek relief or damages. Obsolescence. Obsolescence in real estate refers to the loss of value in a property due to factors such as changes in technology, design, or market demand. There are three types of obsolescence: functional obsolescence, which occurs when a property's design or features are outdated or no longer practical; economic obsolescence, which occurs when external factors such as changes in the local economy or neighborhood conditions negatively impact the property's value; and physical obsolescence, which occurs due to wear and tear, damage, or other physical factors. Offer. In real estate, an offer refers to a proposal made by a potential buyer to purchase a property at a specified price and with certain terms and conditions. An offer may include details such as the purchase price, financing terms, closing date, and any contingencies such as a home inspection or appraisal. The seller may accept, reject, or counter the offer, and negotiations may continue until a mutually acceptable agreement is reached. Open house. In real estate, an open house is a scheduled period of time during which a property for sale is open to the public for viewing without requiring an appointment. Open houses are typically held on weekends and are intended to attract potential buyers and generate interest in the property. Real estate agents may use open houses as a marketing tool to showcase a property's features and benefits, answer questions from prospective buyers, and promote the property to the local community.
Congrats! You completed all 300 real estate vocabulary terms. We thank you very much for watching our videos, and we sincerely hope you pass your upcoming real estate exam.